Shall we get started? Good evening, everyone. This is the second of this year's two pre-election panels on the state of the American economy. The purpose and objective of these discussions is not to persuade any of you how you should vote or for whom you should vote, but rather to illuminate the major economic issues that confront the nation at this time and to try to look at them from various angles and encourage you to think more deeply for yourselves about what correct policy prescriptions might flow from the analysis you'll hear. So we're very fortunate to have a really sensational panel for you tonight, all of whom will have a role. We're going to have three initial sets of remarks and then some opportunity for the other panelists to comment on the presentations that preceded them. Then we'll have a little bit of panel discussion amongst ourselves that I will moderate and then open up to questions. And I hope that, each phase of this discussion will prove illuminating and valuable to all of you. We're very delighted to welcome back as the person who will be our lead speaker this evening, Michael Woodford, who's a professor of economics at Columbia University. But Michael is an alumnus of the very school we're sitting in, the Yale Law School, where he took his first economics course in 1977, I think, or 6, from none other than me, and went on to shift gears after graduating from the Yale Law School and get a Ph.D. in economics and become one of the leading macroeconomists of his generation. And then we'll have 4 members of the faculty of the Department of Economics who will speak. Michael will be followed immediately by John Geanakoplos, who's on your second from the right as you face the front. And then Bill Nordhaus will speak about macroeconomic issues. And then we'll have some discussion remarks from Bob Shiller and Aleh Tsivinski. I think it'll be very lively and interesting for everyone. I think that we'll hope to engage you all in discussion. When the question period does arise, there are 2 microphones located, one in each aisle. And if you have a question, when we get to that point, the best solution is not to raise your hand, but to simply rise, go to the microphone, and I'll call on people in sequence from one microphone and the other. So with no further ado, I'm delighted to ask Michael Woodford to give an opening talk about macroeconomic conditions since the onset of the Great Recession. I should have said the focus of this panel will be the macroeconomy, what's happened to it over the last few years, and what kinds of potential policy options there are in the years ahead. The last panel, as you know, focused on taxation and healthcare, 2 central issues in the current presidential debates. But the overall question of how to get the macroeconomy moving again, how to raise aggregate output in the economy and reduce unemployment will be the major focus of today's discussion. Michael.
Thank you. It's a great pleasure to be back at Yale. In addition to having had President Levin as an undergraduate instructor, before he was President Levin, he was just Professor Levin. Professor Shiller was also one of my teachers in graduate school, and so this feels a little bit like an oral exam, being asked to talk to you. But I'm very happy to be able to be back at Yale. So I wanted to start my talk and to some extent set the stage for what we're going to be talking about in all of the presentations by first reminding you something about what the U.S. economy has just been through and the extent to which there are still concerns about the health of the economy. First of all, the most obvious measure of the extent to which the recession that we went through was a serious one is to look at the path of real GDP, a measure of overall activity in the economy, and that's shown by this blue line. And the two shaded blue regions are the two most recent recessions, both periods of slowdowns in economic growth. And you can see that that most recent one, the recession that started in late 2007 and officially ended in the middle of 2009, involved a very substantial decline in real production in the economy, a much bigger decline than, for example, the previous recession back in 2001. Another thing I wanted to point out is not just the size of the decline, but the slowness of getting back to a normal level of activity. And you can see that it took until late in 2011 for real GDP to be back where it had been at the beginning of the recession. But the dashed red line is showing the CBO's estimate of potential output, which should have continued growing as the labor force grows and productive capacity presumably is growing for other reasons. And given that estimate of the economy's capacity, we're still way below it. As of second quarter of this year, around 6% still below the economy's level of capacity, and that gap is in fact not being closed very quickly. And so that's a reason for continuing concern. Another way of asking whether production in general has gotten back to where it ought to be is just to divide it by the population and look at real GDP per capita. Here you see, even on this measure, it hasn't gotten back at all to where it was at the beginning of the recession, and of course just getting back to where it was would itself not be that much of a victory, since ordinarily real GDP per capita has a steady upward trend. Looking at employment is a particular concern, even more worrying than just thinking about GDP as a measure of what's going on, is the number of people able to have jobs. Here what I'm plotting is employment in the non-farm business sector. You see it fell very sharply during the recession. It has been coming steadily back since late in 2009. There's been a lot of discussion in the electoral campaign of the millions of new jobs created since then. But if you look at a comparison of that to the number that were lost, you can see we're still not close to being back to even the level of employment that there existed at the beginning of the recession. And again, the labor force has been growing, so even that would not be that much of a victory. Another way to think about employment relative to the size of the labor force is to look at the unemployment rate, and that's a statistic that a lot of attention has been paid to the last few years. One sees that it went up very sharply from below 5% unemployment up to a little above 10% unemployment as a result of the recession. That's a much bigger increase than, say, in that last recession, about 3 times as large in terms of the number of percentage points increase. Again, we've been making progress since late in 2009. Unemployment has been slowly coming down, but it's been a very slow, agonizing process, not anywhere close to halfway back to undoing the increase that had occurred. This is another way of looking at just how big that increase in unemployment is compared to a longer series of past recessions. You see that the increase to a little above 10% is a bigger, higher level of unemployment than even in the worst point in previous recessions in the period since World War II, except for one of them, the 1982 recession. Even when you compare it to the 1982 recession, I think that the baseline that unemployment was increasing above was substantially higher at that point in time. And a lot of economists' estimate of what they think the sustainable level of unemployment in the U.S. economy at that time would have estimated that it was significantly higher, maybe as much as 2 percentage points higher than what it was before the most recent recession. And so the fact that it didn't get quite as high as it did in 1982 doesn't mean that in some obvious ways this is an even more dramatic increase in unemployment. You also see that where we've gotten back to now is, of course, still a very high level of unemployment compared to even the worst points in most of the previous recessions. Another way of seeing what's disturbing about the recent behavior of unemployment is not to just look at the overall statistic, but particularly at the number of longer-term unemployed. Here what's being plotted is the share of the unemployed who have been unemployed for 27 weeks or more. And you see, if you look at that number, it went up a lot during the recession, and went up a lot more than in any of those previous recessions since World War II. So particularly this problem of longer-term unemployment has been particularly severe and is coming back only very slowly. That's a big concern, both because of the degree of distress it involves for the people in that situation, but also because of worries about the continuing consequences for the economy of long-term unemployment as people's skills are degraded and their attachment to the workforce weakens. And so there's serious concern that there'll be lasting negative consequences of this kind of prolonged period of high long-term unemployment. You've seen that the progress back from the recovery has been only partial so far. There's been a certain amount of commentary recently about how slow it is, and some suggestion that maybe it means the policy measures that have been enacted have in fact been ineffective because we haven't bounced back faster from the recovery. One thing a lot of people have pointed out is that compared to these previous U.S. recessions since World War II, this is a relatively slow recovery, and that's true. This is looking at the declines in employment relative to where it was at the beginning of the recession in percentage points for each of those U.S. recessions since World War II. And you see that in the early ones, employment would fall, and then it would bounce back pretty quickly, a pretty sharp V-shaped recession, say in 1948 or 1953. Many of those early recessions, it fell sharply and then came back very quickly. The red line here, which is the most recent recession, it fell further, but it's also been coming back to normal much more slowly than in those previous cases. On the other hand, it's worth pointing out, and many people have, that this is not so unusual if you compare the current recession to previous examples of recessions that resulted from systemic banking crises, as our most recent recession has. Carmen Reinhardt and Ken Rogoff in particular have stressed this difference between the recessions associated with banking crises in their recent book, This Time is Different. And if one makes a comparison of that kind, one finds that it's common for unemployment and to return to normal only very slowly, and one could argue that this time the response has perhaps even been faster than in some of the others, perhaps because of the very prompt policy response this time. So, for example, the response of employment in the case of the Great Depression is now plotted on this. That's the dotted black line there. And you see that employment was falling for the first year and a half in this recession at the same rate, essentially, as it did in the beginning of the Great Depression, but it turns up then much sooner. And in the case of the Depression, even 10 years after, it was only basically back at the level of employment that there had been at the beginning. So it's not obvious that compared to that, things are going badly this time. The chart is also showing you several other systemic banking crisis episodes in other countries from the 70s, 80s, and 90s, and you see that in all of them, employment remains low for a very long period of time. Here's similarly the unemployment rates for those different systemic banking crises, and you see that it both increased more in many of them than it has in the U.S. this time, but also that unemployment would, say, easily take a decade or longer to get back to its previous level. And so from that point of view, perhaps there is evidence, at least consistent with the view, that the fairly aggressive measures on some dimensions that have been taken to combat the recession may have in fact had some important effect. I want to focus in my remarks on one particular aspect of the policy response to the recession, and that's the response of the Federal Reserve that there has been a certain amount of controversy about. I think the Fed has become much more controversial in the last couple of years than it had been before the recent recession. And one of the reasons for this is that the Fed policy has been very unusual on a whole set of dimensions in the last few years. The federal funds rate, which previously had been the main tool of policy of the Fed, has been taken to historically low levels and kept at this extremely low level for a surprisingly long time. The Fed has also made a lot of announcements about its intention to maintain accommodative policies for a long time into the future. It's very unusual for it to be talking that way about future policy, and in particular to be talking about future policy so far in the future. There's been a very large increase in its balance sheet, and in particular, a remarkable increase in the supply of bank reserves. The kind of assets on the balance sheet of the Fed have changed. It used to be mainly Treasury securities, mainly short-term Treasury securities. Instead, it's been holding a lot of other types of assets. For a while, in 2008 and 2009, there was a whole series of special liquidity and credit facilities that the Fed set up that were an unusual dimension of policy. And finally, one of the most controversial things that the Fed got involved in was some interventions to try to avoid more disorderly liquidations of particular financial firms, in particular its involvement in the liquidations of Bear Stearns and AIG back in 2008. So this is showing you the Fed's target for the federal funds rate, how it plunged during the recession, eventually going down to a target band between 0 and only 0.25%, which is where it's been since December of 2008. And that's very unusual for it to go that low, particularly striking that then it stayed at that level and not moved since then. I mentioned the Fed's making statements about future policy. When it introduced this unusually low interest rate target, it announced it would be expected to maintain it for some time. By the following March, they began saying they expected to maintain it for an extended period. In August of 2011, they adopted a more aggressive kind of guidance about future policy, saying they expected to maintain it at least through mid-2013. It was unusual they were announcing a date, but it was also unusual that the date was about 2 years in the future at the time that they announced it, much further in the future than people had thought the extended period would have referred to. Last January, they increased that to saying they expect to maintain the accommodative policy at least through late 2014. And in September, they went further and said they expect to maintain it at least through mid-2015, and also added a statement that they expect to maintain the low interest rates for a considerable time after the economic recovery strengthens. I talked about the changes in the balance sheet. Here you see how dramatically it's just grown in size since late 2008. But another striking thing, that purple region is the supply of bank reserves. You can see a little bit of purple over at the left if you look really close, but many of you probably aren't close enough to tell that there were bank reserves at all before late 2008. It's grown gigantically relative to the previous supply of bank reserves, now around $1.5 trillion of them. That's a massive change in the policy with regard to the supply of bank reserves. Looking at the asset side of the balance sheet, it had mostly been Treasury securities, the blue region, up until 2008. A variety of other unusual types of assets start getting added to the balance sheet after that. The big one now is that light blue region, the mortgage-backed securities that have become a very big part of the Fed's balance sheet that it was previously not really holding any of. So some questions that this has raised. I mean, there are many questions I think that it's raised. One point of controversy is whether the Fed simply has too much discretion and too much power that it can exercise without having to be accountable to anyone else, given that it's doing lots of things that people had not maybe realized it could do before, had not expected maybe that it ever would do. Now we see them doing these things. There are questions about whether it's been intervening in markets too much. There are questions about whether some of its current actions might be dangerously inflationary. In particular, that massive increase in the supply of bank reserves has been argued by some people to be something that's building up a potential for massive future inflation. And finally, these statements talking about future policy years in advance, some think that's really reckless because if you're making promises about policy that far in the future, you're tying your hands or the hands of your successors in a way that can't make sense if you have no idea what economic conditions are really going to be like in 2014 or 2015. In trying to address these things, I think it's important to at least separate two different parts of what the Fed has been doing. It's obviously been doing many things. I think it's important to at least distinguish, though, between what I'll call phase one and phase two of these unconventional policies. Phase one, which I would call basically the things it was doing through 2009, were essentially unusual actions that were motivated as emergency measures to counteract a perceived breakdown or threat of complete breakdown of financial intermediation in the U.S. economy. John Geanakoplos, I think, will talk more about what was going on in the financial sector and what the problem was. The Fed was essentially trying to respond to this in two ways. One, providing credit through special means to the financial sector to avoid further failures of financial institutions that it was feared could lead to a complete collapse of the financial system. Secondly, the Fed stepped in itself as a lender, in some cases because it perceived the financial sector as not providing credit where it was needed, and temporarily the Fed was stepping in itself. Phase two is instead about something else. Since 2010, the financial sector has been in a more healthy and more normally functioning situation. The unconventional policy measures haven't all ended. Why? Well, it's because of this slow return of the real economy to normal that I was showing you the previous slides about. In this second phase, the Fed has not had different goals than its normal goals. Basically, it's been thinking about the usual goals of monetary stabilization policy, which is keeping the economy operating at close to its potential while keeping the lid on inflation. And that's basically what it's been having to think about since 2010. But it's been pursuing these standard goals through non-standard means. Why? Because its normal means, which would be cutting nominal interest rates, wasn't possible because this zero lower bound on the federal funds rate had already been reached. Evaluating some of the specific things, I think that probably the most controversial thing the Fed had done was getting involved in the rescues of particular institutions. And I think there's good arguments for saying it's not obviously ideal for the central bank to be making decisions of that kind about who to bail out on its own, because it's not a political institution. It doesn't have political accountability. In their defense, I think one would have to say that the things the Fed was doing in 2008, it did only in coordination with the Treasury. I think one could view it as acting as the agent of the Treasury. And if you say, why was it involved as an agent? It was because no one else was able to mobilize the funds quickly to do the things that were being done. The Treasury itself couldn't have access to funds without Congress appropriating them. That would be a slow process. The Fed could take action quickly over a weekend if the emergency suddenly appeared over a weekend, as was happening. And so it was not so much that the Fed wanted to seize this kind of power, but felt that under those circumstances no one else could act and that they needed to. To the extent that this is considered problematic, I think it's worth pointing out that the Dodd-Frank Act has already taken away the Fed's authority to do this. So if it was a problem, it's not supposed to occur again. I think a question about that is whether we do have an alternative mechanism for the next time this happens. The next time the Fed will not be able to step in. Presumably, Dodd-Frank will also set up some other resolution mechanism for the big banks to solve this. Let's hope that that side of things also does get taken care of. With regard to the special credit facilities that were set up, essentially the Fed viewed itself as having to be a financial intermediary, substituting for the things that were normally being done by the private financial sector, because some parts of the financial sector were basically not functioning. Here's an example of the kind of thing that motivated the Fed stepping in and some evidence that it had an effect. What's being plotted here are spreads between yields on certain categories of commercial paper and the level of the interest rate that banks expected to be able to borrow in the federal funds market over the next month. And what you see is these spreads shoot up substantially in September of 2008, and that's after Lehman Brothers has failed and various other dramatic things are happening in the financial markets. The spreads shoot up, and this is evidence, certainly the Fed took it as, and I think reasonably took it as evidence that financial markets were no longer functioning efficiently to ensure that people in different parts of the financial sector were able to borrow on similar terms. What actually happened here in particular was that the money market mutual funds that had normally been buying the commercial paper were suddenly unable to obtain funding. There was a scare that Money market mutual funds could fail. People were pulling their money out of them. They were no longer able to finance the commercial paper market, and so these commercial paper spreads are shooting up. What the Fed did was set up a facility, the Commercial Paper Funding Facility. That's what the CPFF up there stands for, and the amount of commercial paper the Fed bought under this new facility is shown by the solid blue line. So it comes in a few weeks after these spreads are shooting up. It's directly in response to that. The spreads on the lower three lines on the chart come down immediately once the Fed sets up this facility and starts buying. Those are the three types of commercial paper in the chart that the Fed was buying. Those were eligible to be purchased under the facility. Those spreads immediately come down, so it does seem that there's an effect of the kind that was desired, which is to restore financing on more normal terms as seen by bringing these spreads back to a more normal level. You can also see from the figure that the Fed's involvement in the market didn't last very long. The solid blue line is the Fed's holding of commercial paper. By a year later, it's basically being completely phased out. It was a very temporary program in response to a very temporary emergency, and I think in general all of the special credit and liquidity facilities are like this. This shows you the amount of lending by the Fed under those different special programs. They were essentially all wound down by pretty early in 2010. What about the more recent phase, continuing unconventional policies? Well, the justification for that is that, as I showed you before, output has remained still far below potential for several years. At the same time, inflation has remained subdued, even below the Fed's normal target rate of inflation, and under those circumstances, they thought further monetary stimulus is justified, but further cuts in the federal fund rate weren't possible. Hence, they've tried to use a variety of unconventional policies to provide further stimulus. What about the worry that this big increase in the supply of bank reserves is something that should sooner or later cause massive inflation? I think that's a misunderstanding. It's based on the view that in the past, big increases in bank reserves, much smaller increases than that one, would in fact stimulate spending and eventually the level of prices in the economy. But that occurred because in the past, the interest being paid on reserves was well below other money market interest rates, so there was a very substantial opportunity cost to banks to holding reserves, so increasing the amount they had to hold by even a modest amount would require important changes in financial conditions to get banks to be willing to hold the additional reserves. That has not been true in this more recent period because other money market interest rates are very low right now. They're as low as the level of interest being paid on the reserves. What if that changes? What if the level of interest rates elsewhere in financial markets that are necessary to contain inflation rises substantially, and so it wouldn't be possible for people to still be willing to hold these large reserves without paying a lot more interest on them? It's still going to be possible for the Fed to adjust policy to head off the inflationary pressure in one of two ways. It could either remove the reserves, and if you say, well, it's not plausible that it could remove them quickly. Japan, in fact, did something similar with its quantitative easing experiment in the early 2000s. When they ended that experiment in 2006, the newly created reserves were largely taken out in the space of a few months. On the other hand, and I think maybe even more plausibly, the Fed could start paying a higher interest rate on reserves so that there would continue not to be an opportunity cost of holding them. In that way, it would be possible for interest rates in general in the economy to become higher if that became necessary to contain inflation. So I don't think it's inevitable for some mechanical reason that the current level of bank reserves should be causing inflation. There could be a question, a potential risk here, about whether the Fed would take prompt action if it was necessary to do one of the two things I just mentioned when conditions change. But I don't think that's a question of economic feasibility. That is conceivably a question of political will, and that's something we might want to worry about in an environment when the Fed is under many more political constraints at present than used to be true a few years ago. There haven't been signs of inflation so far. I think since I'm running out of time, I'll skip over that, but it certainly hasn't shown up yet. What about this issue of making promises in advance about policies years in the future? I think there's a clear reason for the Fed to be trying to do this as a substitute for interest rate cuts, and that's that to the extent that it can give people a reason to expect interest rates to remain low for years into the future, that should be a substitute for further interest rate cuts now in terms of its effect on spending decisions. So economic models imply that the expected path of short-term interest rates many years into the future should be important determinants of longer-term asset prices, things like the value of the dollar, which are things that in turn should have important effects on current spending decisions. So there's a clear reason for what the Fed is doing to have some relevance to current conditions. I think the idea of making an unconditional promise to maintain interest rates low until a fixed date far in the future, regardless of what happens between now and then, is something that could indeed be unwise. That's not really what the Fed has done. They haven't made an unconditional promise. The mid-2015 date, if you read carefully, is a current estimate of how long they envision keeping the rates low, not an unconditional promise. They talk in that statement that I mentioned about economic conditions and how the length of time that rates will remain low will depend on how the economy is developing. I think that, in fact, does make more sense, and I wish they would move further in that direction of clarifying what these conditions are that will determine when it's appropriate to raise rates, but I think they are moving in the right direction by talking about it the way they have. Finally, just to say one thing about the kind of issues that have come up a lot in recently politically, there have been proposals to try to cut back on the Fed's discretion of one kind or another. One proposal is change the Federal Reserve Act so that the Fed's legislative mandate only refers to price stability. Another proposal, the Republican platform, calls for establishing a commission to investigate the usefulness of the gold standard, which would also be constraining monetary policy. I think it would be perverse to be doing things of either of these kind at the present moment. I could have imagined a few years ago when inflation had been kept quite stable for the previous 20 years, and that had been associated with a lot of stability of the real economy. One could imagine people arguing, and some people were arguing, that maybe simply keeping prices stable itself automatically stabilizes the real economy too, and therefore just pursuing price stability would be enough. I think right now it would be very hard to make that argument because inflation has been kept very stable. I skipped over those slides, but inflation has been kept stable, inflation expectations have been kept stable. I don't think very many people think the level of utilization of real resources has therefore been fine, so it looks like that's not enough. So this would be a strange time to take out of the Federal Reserve Act reference to the goal of maintaining a high level of employment. Another proposal in the Republican platform is calling for a congressional audit of the Fed's monetary policy decisions. I think, again, after what we've just been through, recent events have shown how complex the issues are that the Fed has to deal with. I think that the advantages of allowing neutral technical expertise to be deployed rather than putting it all up for debate in Congress, the creation or not of each of these special programs, many things had to be done quickly in response to rapidly changing events, that it would be particularly perverse to be thinking of doing that right now. And I think maybe I should stop there. Great, thanks.
John. Right here. Okay, that's great. And you're up. Okay. So, I'm going to talk a little bit about what I think caused the crisis, and in understanding what caused the crisis, try to figure out what we should do about it. So, as Michael so carefully and cogently argued, Ben Bernanke, the head of the Federal Reserve, took many extraordinary measures in the middle of the crisis, but since then has settled into a strategy of keeping interest rates low. First, the short rate he reduced to zero, and now by buying all these assets, that was increasing the balance sheet and promising to keep the short interest rate low for a long time, he's trying to get the long interest rates to be low too. So Ben Bernanke's a good man. I was in school with Ben Bernanke. I know he's a good man. He dearly wants to put Americans back to work. He also wants to stabilize the economy, and he also wants to keep inflation in check. But one man can't do everything. He needs more policy tools, and he needs more help from the rest of government, and that's going to be my theme. Now, the problem today is basically threefold. There's the unemployment that Mike Woodford talked about and showed you. There are too many people who can't get loans, not because they don't want to pay the interest rate, which is incredibly low, it's just that no one will give them a loan, even though they're willing to pay the interest. And lastly, there are too many people being thrown out of their houses. There are going to be 8 million households thrown out of their houses in foreclosures before the aftermath of the crisis is over. So why didn't we do something directly about the three problems that confront our country instead of leaving everything to Ben Bernanke and the Federal Reserve? We should have forgiven, I'm going to say, some of that household debt, that is the mortgage debt, that wasn't going to get paid back anyway, that we knew wasn't going to get paid back anyway. We would have made the lenders better off and the borrowers better off if we'd forgiven part of it. We should get people to get more, we should make it easier for people to get more loans who are willing to pay the interest rates, and we should put more people to work directly, say by improving our infrastructure. Monetary policy can't solve all these things by itself, it's too blunt an instrument. So how did we get into this mess? You know, it's an exciting time to be a macroeconomist. This is the worst disaster that we've had since the Great Depression. And let's face it, macroeconomists didn't really predict that this was going to happen. And we're still 4 or 5 years after the crisis began, we're still in the throes of it. So clearly, it's an opportunity, if you're a macroeconomist, to develop a new theory or to revisit an old theory that maybe was ignored. So many people here in this audience, partly of distinguished economists, are doing that very same thing. So I'm going to talk about, one of my theories, but I think, which I call the leverage cycle. So this is what I think was the reason we got into this mess. And it basically works like this. If you have an asset that has a value here, normally people can borrow, say, 40 or 50% or 60% of the value of the asset. If you get a loan and use your house as collateral, maybe you could borrow 60 or 70% of the value of the house. But then leverage, that is the loan to value, goes up and up and up, and the effect of that, borrowing goes up on the same collateral, that, it turns out, pushes the price of the collateral up. So the price of the collateral goes up, and now you can borrow 95% of a higher value. So the amount of borrowing goes up once because the ratio went up, and then again because the level of collateral goes up and you're at a higher ratio. So the level of borrowing is much higher. And then what happens when something goes wrong with the collateral and the price falls below the debt? People are now underwater. So who loses money and who goes bankrupt? It's the people who borrowed the most, but they're the most optimistic people, keeping the prices up. So the prices fall some more. Then the lenders get nervous and they say, well, we can't make any more loans. Now no one else can borrow, and so of course there's no demand, and the price goes down even further. And so you're left with a huge debt and very low asset values. And that gap is what I think has caused the long aftermath. Too many households, too many businesses underwater. And so when the gap is too big and it'll never be paid, that's where some forgiveness, I think, can help everybody. So I regard this partly as common sense, but it can't be totally common sense because the implications of it still haven't been accepted. The Fed ought to have more tools, not less tools. It ought to be able to regulate leverage to prevent 95 or 97 or 99% LTV on borrowing on households. The country as a whole should have had some sort of principal forgiveness, and we macroeconomists should put endogenous leverage into our models. So the Fed ought to be doing more, I think, not less. It should be managing leverage as well as managing interest rates. And as I always point out, I can't resist pointing this out, this is not an original idea. Shakespeare himself had this idea in The Merchant of Venice. It's all about a loan, but there was an interest rate negotiated in the play, but none of you can remember what the interest rate was. You all remember the collateral, the pound of flesh. the collateral. And so he knew it was more important than the interest rate. And secondly, the rest of the play is about forgiveness. When the boats sink and it doesn't appear that the debt can be repaid, the judge, who's someone else in disguise, says, mercy, it helps him who give it and him who receives it. It makes everybody better off if something totally unexpected happens. And so that's the theme of what I'm going to be talking about. So by leverage, I mean several ways of saying the same thing. The loan to value we described before is one way of saying leverage. Another way of saying it is the down payment. If you get an 80% loan on a $100 house, $80 loan on a $100 house, it's 20% down payment, 80% you borrowed, that's the loan to value, and the leverage is 5-to-1 because $20 of cash got you a $100 asset, all the same thing. So in standard economic theory, we talk a lot about the interest rate. Supply and demand determines the interest rate. But in that theory, anyone who wants to borrow at the interest rate can borrow. In my theory, which a number of people are working on, I shouldn't call it just mine, but in the theory of the leverage cycle, you have another variable. What's the loan to value supposed to be? And it's a little paradoxical. How can one equation, supply equals demand for a loan, determine the interest rate and determine the loan to value? But anyway, you'll have to read about the theory. So it turns out that in the theory, impatience determines the interest rate, and how worried the lenders are about getting paid back determines the loan to value. If they're very nervous, they're not going to let you, if the asset price might fluctuate, they're not going to let you borrow as much, and loan to value will be low. Also, innovation always stretches collateral and makes loan to value higher if it's unchecked. So people have talked about leverage at least since Shakespeare's time. I'm sure Shakespeare understood what every business person understands, that if you buy an asset like a house with $20 of cash and it goes down $1, you still have to repay the $80 loan, so you're left with 19. So although the house only went down 1%, you lost 1 out of 20 or 5%, 5 times leveraged. So that's why leverage is dangerous to banks. But the point of the theory is that it's not just that it's dangerous to the person doing the leveraging if the banks are too leveraged, it also forces asset prices up. Okay, and that's the main theme, that when you can borrow more on the house, it pushes the price of the house up. Now, why should that be? Because in general, there are lots of potential buyers. Some of them think the house is worth more than others. You can put them on a vertical line. The people who think you want to pay the most are at the top, and the people who want to pay the less, they're at the bottom. Whatever the prices are of securities or houses or anything like that, there'll be some people, the marginal buyers, who think the prices are fair. The people who have higher opinions will become the buyers. The people with lower opinions will become the sellers. Now, as leverage goes up and you can borrow more, it requires fewer people to buy all the available assets. So the marginal buyer goes up. But the marginal buyer is the guy who thinks the price is fair. So that means the price is going to go up. So even though no one changes their opinion, just by letting the optimists be able to borrow more, you're going to inevitably push the price up. So that's the basic idea of what happens. When there's low volatility and the lenders aren't worried, leverage goes up, the asset prices go up, the optimists acquire more and more of the assets, and then something goes wrong, and it sets the stage for the crash. So the crash always has the same thing. There's bad news, as I said, that kills the most optimistic buyers who borrowed so much, and then the lenders get nervous and suddenly they won't lend as much. So you take the original set of buyers above the original marginal buyer at the X, they get wiped out because the price is going down, and then the remaining buyers, the people here, are wiped out. So who's left to buy? These people. But now you have to have many more of them because they can no longer borrow, because now there's deleveraging. You can't borrow because the loan to value that you can get from a lender has gone way down, so you need far more people. So the marginal buyer goes from here all the way down to here, and that's why the price has collapsed. So anyway, so you get, because of leverage, too high prices and then too low prices, and that leaves people in tremendous debt. I think that's what happened in our crisis. That's where we are now, and that's what we have to have dealt with, and we should have been dealing with for the last 4 years. So this kind of thing, I think, has happened repeatedly, and so this is a famous picture of, Sorry, I skipped a few slides. This is a famous that green line represents the housing index. It's a Bob Shiller story, graph even, from 2000 to its height in 2006. On the right axis, it went from 100 to 190, 90% increase in 6 years, incredible housing boom. Why did it happen? Well, he says irrational exuberance. That probably played a big role. But in addition to that, if you look at the loan to value of the average loan taken out, non-government loan for housing, it went from 14% down to 2.7% down. That was that was the down payment people were making on loans, 2.7% down to buy a house. That's what I think played a big role in driving the housing prices up, and this drop in leverage is what helped bring it down. Okay, so if you look across countries, you take countries and look at 1997, the debt of households versus their incomes, and you look at countries like Ireland and 2007, you see the dramatic increase in debt of households to income in some countries like Ireland and the UK and Spain and Portugal. It soared. In other countries like Germany and Japan, it didn't change at all, even went down a little bit. And then if you look at what happened to housing prices, in all the countries where debt soared, the housing prices soared. And in the countries like Germany and Japan, where debt didn't go up, housing prices didn't go up. And if you look at which countries suffered as a result of the crisis in the first couple of years, it's the same countries who had all the debt. Okay, so the same is true of securities as houses. So the crash, in my view, started, what was the scary news that started it off? It was people getting delinquent, and just a little bit delinquent. So delinquencies went from 2% in subprime loans to 5%. You might think of that as a tiny change, it hardly matters, but when people go from 2 to 5 all of a sudden, it gets lenders worried it's going to go higher, and so they demanded more down payments. That's what I think started the whole thing off. Okay, so where does that leave us now? What should we do about the leverage cycle? Well, what we should do, I think, is we should have prevented this from happening by curtailing leverage to begin with. And if Ben Bernanke had more powers at the beginning to curtail leverage, then we wouldn't have had this 97.5% loan to value, 2% down payments for a typical mortgage loan. Housing prices wouldn't have gotten that high, other asset prices wouldn't get that high. Perfect. So, so that's the first thing that we should have done. We could have prevented this crisis by curtailing leverage. Okay, the second thing, in the middle of the crisis, what happens is everybody gets nervous. And so in the middle of the crisis, it's almost impossible to get a loan. So what should have happened is what did happen. The Fed stepped in and made loans not necessarily at a lower interest rate, which they tried, but also making loans to people who didn't have very good collateral. So they changed the loan to value. It would have taken incredible amount of collateral to get a loan, and yet the Fed was willing to give, and the Treasury together were willing to make loans, and Mike referred to these in these extraordinary times in 2008 and 2009 that they abandoned immediately afterwards and said, we'll never do it again. Well, I think they abandoned it too soon. And then the third thing you have to do is in the aftermath of the crisis, when you've got this huge gap and people underwater, you have to forgive some of the debt. And that's the biggest mistake, I think, of the Obama administration. 5 years ago, the housing market started to collapse, 6 years ago. So we're going to have 8 million people eventually kicked out of their houses. That's 8 million households. That's 24 million people on average if you have 3 in a household. It's an astonishing number of people. Now, what did the government try to do? Of course, the government recognized the problem. It tried to lower interest rates on mortgages and to those people who were having trouble making their payments. But as I wrote 4 years ago with another law professor who was trained here at the Yale Law School, that wasn't going to do the trick. What we had to do was forgive some of the debt. Now, if you take a typical subprime loan that's for $160,000 and the house has fallen to $100,000, it must be down to 2 or 3, then at $100,000, a loan of $160,000 and a house is now only worth $100,000, it's crazy to think the person's going to pay. In fact, if you throw him out of his house, as we're doing now with all these millions of people, the lender on average got $40,000 back or $35,000, less than a quarter of the money back. The guy sits in the house for 3 years not paying his mortgage, not paying his taxes, not fixing the house. It's no wonder you get so little back by throwing people out of the house. Had you forgiven 160 down to 90, you might have gotten the 90 instead of getting the 40. The homeowner could have stayed there and the lender would have been better off. Okay, so it was all predictable in late 2008 that this was going to happen, because here, if you see people who are far enough underwater, the rate at which they were defaulting was 7% a month. This is loan to value. If you're 160 loan to value, you're defaulting 7% per month. If you're a subprime borrower, why would you pay if you owe so much money? You have a bad credit rating to begin with. You're not losing that much by defaulting. Of course they were going to default, and it was going to be disastrous. So writing down interest, as the government did, just produced a bunch of people who redefaulted anyway. So this is 18 months after someone's interest got reduced. 18 months later, 70% or 80% of them had redefaulted. The plan of just writing down interest doesn't work. You have to do more. So forgiveness, I think, is the key. It helps in the right circumstances, the lender and the borrower, and we have somehow a moral aversion to forgiving, which is hard to understand. The same problem occurs in Europe, where the Troika is asking countries that can't possibly pay the entire debt to pretend that they're going to pay it. Instead, they're told, if you look like you're going to pay it, we'll lend you more money and put you in more debt. Instead, they should be told, if you do some reforms, we'll promise in the future to forgive some of your debt. We'll get more money in the end, and you'll be better off. Okay, so the final thing is, what have we done? We've just lowered interest rates. We've left everything to Ben Bernanke. And we've practiced in Europe and here a kind of fiscal austerity. We have to balance our budget, so let's have some austerity. I think that austerity is counterproductive. This has been said by Keynes and by Krugman in the New York Times over and over again. But really what Krugman is saying is that we should delay austerity. Now in the crisis, don't have austerity, spend now, and then try and reduce the debt later. I'm agreeing with Krugman that too much austerity is a bad thing, but I want to go much further. We should have had some forgiveness, and we wouldn't have had this crisis. So we've cut the interest rate, the short rate, to zero in 2008. Bernanke spending $3 or $4 trillion buying long bonds to reduce the long interest rate, yet we still have low housing prices, we still have foreclosures, we still have borrowers who can't get loans, and he may be causing another crisis. Okay, so if you look at what's happened, second to last slide, if you look what's happened, here are the prices of a bunch of assets like high yield, all kinds of mortgages, treasury bonds. Starting at 2008, December 2008, they've all soared. By buying all these long assets, he's helping to force the price of every asset up. It's amazing. If you're an investor, it's a great time to be an investor and buy all these soaring assets with Bernanke and the Fed pushing the price up. The only thing that hasn't gone up is housing. That's the one at the beginning. We're at the same housing level as we were after the crash. We haven't got housing to go up at all. It's actually a little down from where it was in December 2008. Okay, so if you look at people trying to get loans, sorry, one more slide. Look at people trying to get loans, and you see that people with bad FICO scores, they can't get any loans. Compare the loans in 2006 to 2012. None of those people are getting loans. Actually, my FICO score is in here, and it's amazing I can get a loan. And so, what have we done? What we're doing by lowering interest rate, I think it's a kind of trickle-down economics. We're raising the price of everything. If you own stock, the stock market's going up. If you owned high-yield bonds, the high-yield bonds are going up. The rich are getting richer because the Fed wants them to be richer, so they'll spend a little money. That's trickle-down economics, okay? Because the government now no longer has all these long loans out, that means we're in danger when the interest rates go up, that the government will have to pay high interest rates, and it's going to hurt our budget. If they're all long loans, they're outstanding. If we didn't buy them all back, the interest rate would have been locked in. And lastly, we may have an unintended consequence of causing a bubble like in high end. So Ben Bernanke's a good man. He's trying the best he can. He deeply believes in what he wants, but he can't do it by himself. We should have helped him by putting people to work and by forgiving something. We needed the Treasury and the Congress to do that. Okay.
Professor Nordhaus.
Okay, thank you very much. So, you all are very close observers of the election. You've listened closely to the debates, and what have you learned? Nothing. You've learned nothing at all about economic policy. You've learned more tonight than you have watching 6 hours, 8 hours, 9 hours of debates. And that's because the candidates have avoided all the major issues that we're facing. You've heard two great presentations about money and financial markets and a little about fiscal. And what I want to do is I want to look primarily at fiscal policy, and I want to look forward. Now, incidentally, it's not inevitable that you can learn nothing from debates. If you go back to 1858, after all, you learned a lot in the Lincoln-Douglas debates, but it's true they were given 2 hours, not 2 minutes, and that helps a lot. Now, what are the key economic issues that we're facing? We're facing the fiscal cliff, which I'll talk about. We're talking about the economic recovery, which John and Mike have talked about. We're facing a long-term fiscal gap, the issue of controlling health costs and protecting core government functions. So I'm not going to talk about all of those in detail, but I do want to talk about a little of them, each of them. Now, let's talk first about the fiscal cliff. Now, what's the fiscal cliff? Well, there's a little mixed metaphor here, but everything goes poof on December 31st, 2012. Your tax cuts expire, your doctors don't get paid, the unemployed lose their insurance, the military and government programs are slashed. Now, you might want to know what exactly are the details. Well, they're pretty complicated, and I won't go through all of those, but this is what's involved in the fiscal cliff. The Bush-era tax cuts, $295 billion. The payroll tax cut, $127 billion. Other expiring provisions, $87 billion. Other tax cuts, $105. The Affordable Care Act, $24 billion. Plus, then you have in spending, you have the Budget Control Act, which is the sequestration, which is the sword of Damocles coming down on the military and other programs. You have more unemployment insurance. You have the doc fix is in that, and you have other things as well. So a total of $809 billion at an annual rate. That's about 5% of GDP. That's what will happen if we go off the fiscal cliff. Now, if that happens, it's going to be a real bad year at the beginning. Now, what are the contentious issues? There are actually almost none. The contentious issues are the high-income tax cuts that the two candidates have been debating, and the taxes included in the Affordable Care Act. That's a very small fraction. That's about 10% of the total cliff. So we'd only go down 10% if everything else were passed. Will we drive off the fiscal cliff? I don't know. I don't think anybody wants to. But nobody wanted World War I. Nobody wanted World War II. Nobody wanted to spend 10 years in Iraq, but things happen. And as our distinguished chair in economics, as he teaches the students, I hope many of you are here, about the game of chicken, there's some bad equilibrium. Economic recovery. Well, Mike talked about this at length, so I'll just say a couple words about it. First, it is an incomplete recovery. We're about, so that's the red line there is the unemployment rate. The numbers on the left are the unemployment rate in percent. That bluish band in the middle is what is thought to be full employment as calculated by the Congressional Budget Office. I've put a little error band around that because we don't know it for sure. So if you look from the peak, we're a little less than half of the way back from the peak in 2009 of the unemployment rate back to what most macroeconomists would consider full employment. So we've made some progress, but we've got a long way to go. Now, Mike used the phrase, "this time is different." I think that's important because there actually are some important structural differences in policy. And the most important one, I think, is that, which he spent a long time on, is that monetary policy is constrained by the zero bound. That's a zero bound means that interest rates cannot for all intents and purposes, go below zero. They can maybe go to minus 0.1%, but they can't go down where we'd want them, is minus 2% or minus 3%. Everybody but John, who doesn't want them down that low, but many macroeconomists do, and the Fed surely does. Now, the government has two hands. It has a monetary hand and it has a fiscal hand. And we've been talking this afternoon, this evening, primarily about the monetary hand, and I want to talk about the fiscal hand. Now, the first important part of the fiscal policy was the Stimulus Act, and the Stimulus Act was the Stimulus Acts, ACTS, because there were stimulus under the Bush administration before in 2008, and then there was the big stimulus package, which has not been mentioned by the candidates, in 2009. Now, I think most economists, macroeconomists, think that the stimulus package helped in preventing a worse economic downturn, so that if the stimulus package hadn't been passed, that red line would have been higher in 2009, 2010, and 2011. And I think if we look at the constraints that are operating on monetary policy, we need more, not less, fiscal stimulus. We need less austerity, as John mentioned. We need actually we need fiscal stimulus, not to cut spending and increase taxes today. So if you actually listen to the debates, you would have been completely misled because they had it backwards. Nobody said, we need more stimulus, we need another stimulus package, but that's what we need. Now, what's confusing about this, I mean, we have two eyes and two hands, but it's hard to chew gum and walk at the same time. So what's very confusing is that while the U.S. needs fiscal stimulus in the short run, it's in an unsustainable fiscal position in the long run. And this is, this is two projections of the debt-GDP ratio. These are by the Congressional Budget Office. And up till 2012, those are history. And the two dashed lines are the two policies. The one is what I call the cliff policy, is go off the cliff, raise taxes, cut expenditures, and just full speed ahead, Greece and Spain. The kick the can policy is let's actually extend everything. Extend all the tax cuts, extend the payroll tax, don't have the sequestration, let the health programs go ahead. That's actually what's likely to happen if anything happens, is the kick the can policy. What you can see is that if you follow the cliff policy, even though you have probably a pretty bad recession, you do reduce the debt-GDP ratio, but the kick-the-can policy has what is called an unsustainable path. You can see that that's a long way off, obviously, but this is just looking at what the implications are of our policy. The debt-GDP ratio is off the charts. Now, the chairman instructed us to give some geeky details, so I have one geeky slide today. What is needed for fiscal sustainability? So there's a new concept I would like to introduce to you. It's not a very deep concept, but it's called the primary surplus or deficit. And you take the budget and you take out interest. It's real simple. You just look at all spending except interest and all revenues. And that's called the primary surplus or primary, in the present case, primary deficit. Now, here's a really interesting rule of thumb that you can remember, which is if you want your debt-GDP ratio to be constant, your primary budget must be in balance. Okay? It's a very simple rule. It's actually correct. If you actually look at the numbers, when our primary budget was in balance, then the debt-GDP ratio stabilized. So what we need to aim in the medium run for primary balance. Well, where are we? Well, this shows up to 2012, the history, and it was basically in balance until about 2006, and then went way south. The cliff policy, which is above the line, actually has a primary surplus, and the kick the can policy has a continued primary deficit. So you need something in between. You need somewhere in between. Now, what about taxes? Well, this is my favorite quote, and whenever anyone says taxes, this is what I would say. I would quote Justice Holmes, who says, taxes are what we pay for a civilized society. We can't have the things we need, the core functions of government, unless we pay for them. So it's like when you buy something, you need to pay a price, and the price is taxes. And one of the things we have to recognize is we need to pay a little more if we're going to have a civilized society. Okay, so what are the ingredients for a fair and sustainable fisc? I have a 5-point plan. All right? It's a little different from the 5-point plans you've heard, but just to give you the kinds of things that are necessary to close a fiscal gap, to get back to primary surplus, primary balance over the next few years. We need about 5% of GDP to close that gap. And here are 5 things, each of which you can get about 1% of GDP on. One is the expiration of the Bush-era tax cuts and the tax preferences for upper incomes. That's about a little less, but about close to 1% of GDP. A second one is, now that everybody has heard about climate change again, they heard about it in Katrina, and now they heard about it with Sandy. So a carbon tax of the kind that's been recommended by many economists will raise about 1% of GDP in revenues. We need to cap the growth of healthcare costs. I'm sorry, folks, but this is one where the Republicans are right. The Republicans have a head but no heart, and the Democrats have a heart but no head. And on this one, you actually are going to have to do something to cap the growth of healthcare costs over the next 10 to 20 years, because it's going to drive out every other core function of government if you don't. A fourth thing is we're going to need to raise the retirement age on federal programs, primarily Social Security, but it could be also in other programs as well. And you can get about another, probably not quite 1% with that. And then if we curb our military ambitions and spending, we can easily get another % from that. So you take all those and you get 5% of GDP. Now, let me end with the question I started with, which is, where have all the grown-ups gone? Well, I think they're here, but I think they're huddled. I think they're huddled in the shelter against the hurricane. Now, I'm not talking about the hurricane, the natural hurricane. I'm talking about the man-made hurricane of the money that's sweeping through our economy, the money, the business interests, the spending of the super-rich individual that's blowing through the country. You have to ask yourself, why is it that the US government, which is the largest economic entity on earth, with spending at 20% of the size of our economy, that's about $3 trillion a year, cannot plan activities even 2 months ahead? Here we are on November 1st, and we don't know what our tax rates are going to be on January 1st. We don't know what our spending is going to be. Our doctors don't know whether they're going to be paid or not. The military cannot plan. That's no way to run a country, and I think we need to ask ourselves how we're going to improve that. Thanks.
You could just refer to it. It's going to take too much time to get a slide back. Are we? Yeah, we're on. Okay. So, well, thank you all for those presentations. I thought I'd ask the other panelists for some reaction to those opening remarks. So, Bob Shiller, you have any particular reactions?
Well,
It's in a 5-minute summary.
is this on? Mike Woodford began with a presentation of the enormity of the problem. We are in the biggest economic crisis since the Great Depression. We are recovering, supposedly. The recession ended in 2009, but it's a very slow recovery. And our gross domestic product is way below the track. It's a rare event. Great Depression was a big event. It was 70 years ago. It could get worse. The IMF, in its latest global financial stability report, said that the world financial system is very fragile, and they use the word alarming for the situation now. I'm not saying I know what's going to happen next, but what is driving a lot of talk in this election campaign is what's going wrong and how do we get some kind of leadership to get us out of that. Unfortunately, I don't know that we have clear answers to the various proposals that our speakers told seem unsatisfying to people. We're in a situation like that which Franklin Roosevelt described in his inaugural address of fear and uncertainty, and that, as Roosevelt said, the only thing to fear is fear itself. So we're in a vicious cycle where people are not spending and businesses are not investing enough. And it's worldwide. We're seeing Asia slow down. We see Europe in a recession. What do we do about that? And that is a fundamental problem that the debaters did not address. Now, all three presenters here did a great job of bringing in some of the economics. It's very complicated. I don't know if you got all of that was just presented. In contrast, the candidates don't seem to have any connection to anything that was said here. In fact, what I did in preparation for this is I took all four debates, the 3 presidential debates and the VP debate, put them in one file, and I searched. The word jobs came up 161 times. The word economy came up 101 times. No economist was ever mentioned. There was no mention of Ben Bernanke, no mention of the Federal Reserve in any of the 4 debates. There was no mention of the commercial paper funding facility that you mentioned. No mention of multipliers, and I'm sorry, there was one mention of leverage. And John, Mitt Romney, you missed it. Mitt Romney is your man.
You can keep him.
Because he said he wants to eliminate Dodd-Frank and replace it with leverage requirements. So those are the issues. What this seems to be about is that Romney is coming forth and saying that there's a fundamental confidence problem or uncertainty problem, and we need a completely different, it's a revolution that he's arguing. We need to move to a different kind of government which is much smaller, that frees up individual initiative, that relies on small businesses, the idea being that somehow this whole problem was caused by the government interfering with the free market economy. That is the same argument that was used by Alf Landon in 1936 when he tried to steal the presidency away from Roosevelt. Now, fortunately, at that election, the economy in the November of 36 was improving nicely. Just a matter of months later, we had a downturn, and Landon would have been probably elected. But still, the doubts persisted. We had one great revolutionary thinker in the Great Depression, John Maynard Keynes, who, by the way, is never, ever mentioned by either side in this debate. Anyway, let me just say, I don't have enough time to present this well, but who are we voting for if we vote for Obama versus Romney in terms of economic policy? This is the big issue. And neither of them is an economist. How could they possibly come up with a solution to these deep problems? Well, it's their advisors, and their advisors are standing in the background rather quietly. Notably, we have Greg Mankiw, we have Kevin Hassett on the Romney side. Kevin Hassett is author of the book Dow 36,000, which he wrote in 2000 predicting an enormous stock market boom. On the Obama side, we don't have Larry Summers anymore, and we don't have Christina Romer. The chief economic advisor right now is Gene Sperling, and I'm proud to say he is a graduate of the Yale Law School, where we are. And he is a smart guy. He has a book called The Pro-Growth Progressive. It's a wonderful book. Nobody reads it. But in a sense, the public isn't interested in legislation that might produce a solution. But I think Obama has assembled a good team. Now, they're not inspired like Keynes was to find a deep and major solution to this problem. But I'll just close by just going through some things in the American Jobs Act, which was the last major piece of legislation proposed by Obama and introduced into Congress a year ago. And I think Gene Sperling's hands are all over this, because I read his book and I see it's not just Gene Sperling. It has innovative ideas in it. I should also give another plug. Do you remember Laurie Kletzer was here at the Yale Economics Department? In 2001, she proposed with Robert Lighten a program of wage insurance that would help protect workers against having to take a job at a lower wage. This would be the confidence restoring thing. That sat dormant for a decade, and then Gene Sperling or President Obama or someone there put it into this legislation. They put into the legislation an American Infrastructure Financing Authority. None of this has happened, by the way, because the Republicans shot this down. But the AIFI would be a government agency that would facilitate infrastructure investment, roads, highways, harbors, global warming prevention things, a whole list of these things. And it would not just be government, it would be public-private partnerships. It's a great idea. It actually resembles an idea that our own Martin Shubik has been talking about for some years, and it goes back further than that. But it's going at the basic infrastructure problems. What else did the Act ask for? It asked for money to pay for jobs for veterans, jobs for teachers, hire back the teachers, a first responder stimulus, which would be hiring back the firemen and the policemen that we've laid off. This is an absurd situation. Because of the weak economy, we lay off these people, and then it only makes the economy worse. It has something called Pathways to Work, Bridge to Work. People are losing skills because they're unemployed for such a long time, so we want to subsidize them being at least partly in the labor force so that it doesn't get worse and worse. Taken together, then the final step, this is what killed the Act. Obama wanted to raise taxes on the top 5%, the top 1%, I'm sorry, incomes over $1 million by 5%. And that would have paid for the whole thing, and it would be a balanced budget act that did not raise the deficit. So it was such a beautiful, maybe it was too small, but it was such a beautiful piece of legislation. Mike Woodford has written a paper about multipliers, and I think you concur, having read your paper, that a balanced budget stimulus works. So we had an act entered into Congress that would have not worsened the deficit, that would have gotten all of these things done. It wouldn't have been enough to bring us out, but it would have done a lot. So in that sense, I'm thinking that this whole idea that Obama has no plan is not really true. I mean, we saw it. It's just that nobody wants to read an act introduced into Congress. It's not well written for the general reader. But there is an Obama plan, and I think personally, has a higher probability of having some success than the kind of nebulous idea that Romney is proposing, that lowering taxes on businesses will free up free enterprise. That no one knows for sure, but my judgment call is that we have except for you with your leverage plan, which is not in the Act. I'll stop then.
Okay, thanks, Bob. Thank you. So Aleh Tsivinski is going to now tell us why we're all focused on the wrong problem.
Okay, all right. So I think everybody's getting a little tired here. So let me lighten it up to you and just try to explain what happened here. So we have, just imagine we have a very sick individual, which is the US economy. And we have a village chief, which is the President Levin, to convene a group of the doctors. This gentleman certainly look like a group of distinguished doctors, but there is one problem. Economists are much worse than doctors in trying to understand what's going on with the patient. So let me explain, I think, what the suggestions are of some of the doctors here. So John Geanakoplos is saying, well, let's read the Shakespeare to this very sick individual. Bill Nordhaus is saying, well, let's give him a lot of coffee. It's going to be a good stimulus for the individual. Mike Woodford, the famous New York doctor, comes with his very fancy briefcase and says, well, let's do MRI, and we'll try to detect what's wrong with this individual and try to figure out what to do. And Bob Shiller is saying, well, there is a plan. Okay? But since we don't know that well about how the economy operates, maybe we should ask the question, maybe it's the voodoo medicine that all of us are proposing here is what is killing, or not killing, or at least making this very sick individual, the US economy, very sick. All right, so what do I propose? Instead of the voodoo medicine, I propose free air and vigorous exercise routine. So what does this mean? It means that perhaps we should just focus not on all of the details we have talked here about, but we should focus instead on economic growth. And let me give you some numbers we should jot it down while listening to this distinguished voodoo doctors. So if you look at the pre-crisis trend from 1996 to 2007, the growth of the US economy was plus 3.6%. Okay, so let's look at the recovery. It was anemic recovery. The patient is sick from the third quarter of 2009 to the third quarter of 2011. So it was 2.1%. So you say, well, 3.6%, 1.5%, 3.6%, 2.1%. It's only 1.5% difference. Is it really a big deal? 1.5% of growth per year. Just think about this number for a second. It doesn't seem like a big deal. It's only 1.5%. Let me give you some numbers for this. Over 5 years, the cumulative difference, if the economy grows at 3.6% versus 2.1%, is 23% of GDP. This is of the order of magnitude of what has happened during the Great Depression, the loss of the GDP. Let's look over 10 years. Over 10 years, the difference of 1.5% of growth per year cumulatively, so if you count how much the economy makes under these two scenarios, will be 97% of GDP. Just think about this, 97% of GDP. So just again, to give you some numbers, I mean, these are all abstract big numbers, and the gentleman looking at how could you get these numbers? It's the cumulative. It's the cumulative difference. So think about the US combined total debt. It's $16 trillion. So it's about the same order of magnitude. 97% of lost GDP is 6.1 times more than total healthcare spending in the US now, private and public. It's 21 times defense budget. It's 15 times the total private and public educational spending. And finally, we all like Yale. We sit here at Yale. For this amount of money, we can build 751 endowments of Yale if we find 750 extra Rick Levins. So these are just giant numbers. In terms of per person, for a family of 4, it's $185,000. So that's what a difference of 1.5% of growth over 10 years is. All right, so what should I say, what should we do? I think that let me just point out to some of the issues which came up, which may be making this anemic patient even sicker. So what do we have? What are the strong headwinds which will generate this significant slowdown of growth? Well, debt. We all know from economic research, and I teach to some of the gentlemen in my class who are sitting there, so that if you have a debt above 90% of GDP, you're hitting the red line, over which the advanced economists get a slowdown of growth of 1% of GDP per year. Taxes. We all know that increase in taxes are hugely distortionary. Not over short term, perhaps, not over some individual, perhaps, but let me just give you some numbers. Better Radlick estimate that 1% average increase in the average marginal tax rate minus 0.6% of GDP. Romer and Romer, the person we have mentioned as Christine Romer, who was an economic advisor for President Obama, estimate that increase of taxes by 1% is minus 3% of GDP. A recent paper by Trabant and Ulick show that if the US were to move to the top of the Laffer curve, and that's not a laughing matter, it's going to be minus 27% of GDP. All right, we'll have to increase taxes probably to cut down debt, and this will lead to serious headwinds for the US economy. Overregulation. How can we say, regulation is bad? Sure, we have seen during this crisis that regulation perhaps was one of the causes of the problem. But the pendulum is swinging to the other side. Maybe we are to decide over the overregulation. There is some recent economic research that shows that if you chop off across countries the three of the worst crises, you would decrease economic growth by 0.33%. It's again, these little numbers add up. Okay, so let's look at the quality of US economic policy. I think Bill Nordhaus is absolutely right. We are seeing unprecedented uncertainty with what is going to happen with the US economic policy. Recent research estimates that increase of the uncertainty in the US economic policy from 2007 to 2009 caused 3.2% loss of GDP. But finally, and this is probably what worries me importantly, or worries me more than even the other things about what I have said, is that I think what we're seeing during this crisis, one of the casualties of this crisis is going to be the way how the US economy operates. I think we're moving to the state where we have much more state intervention, where we think that state intervention is good. And again, so one of the nicest papers I've seen recently, which is by some of the economists from Northwestern and UCLA, that shows that these changes in the beliefs of whether markets or state interventions are good are extremely long running. So what we're seeing is that, unfortunately, I think that the US is going to look more and more and more like Europe. Have we seen something like this? Have we seen the confluence of these factors happening somewhere else? Or am I just, again, talking about some voodoo economics? We have a laboratory for this. And the perfect laboratory is Japan. In Japan, we have seen the lost decade of growth in the 1990s. And the 2000s also was not a very cheerful decade for Japan economy. So what I'm afraid of is that by giving the wrong medicine, all of us actually here are unfortunately gonna make our US economy look more and more like very anemic and very slow growing patient, and we're gonna lose a decade of growth.
Before I open up, anyone want to respond to Dr. Tsivinski's remedies? We'll let the audience do it? Okay.
It's a matter of degree. We don't want to go too far to either extreme, right? We need government infrastructure support. And so the question is, how do you know where to move this?
Yeah, that's a good point. So, I mean, certainly nobody is saying we should not have government. And in fact, one of the things that I think I agree, one of the very few things I agree with President Levin is that perhaps in the long run, the investment in infrastructure is going to pay off. It's going to actually have quite a high fiscal multiplier. However, over the short term, I just don't see the evidence that the fiscal multiplier on infrastructure investment is high. So there is a recent paper by Leduc and Wilson, which we actually talked about in our class for those who nod in their heads, is that in the short run, unfortunately, the effect is not as large as in the long run. So government certainly is needed, but maybe we're having too much government, and all of us here are saying the same thing.
I'll just throw one thing in. I mean, I think the evidence on multipliers that's inferred from a long period of history is not very relevant to the current situation, because we're in a hugely leveraged economy with a huge overhang of debt. And the effects of either tax cuts or spending on consumer behavior are going to be different when you're sitting there with a mountain of debt than when you're not. And so you know, for example, a small tax cut like the payroll tax cut had virtually no multiplier because people paid down debt rather than, in fact, people paid down debt to a far greater degree, 5% of GDP per year. It was the deleveraging of the consumer sector at a time when they're getting this small payroll tax cut. So, you know, I'm not persuaded that job-creating multipliers are zero. I think they're quite positive, actually.
Absolutely, Rick. So I think you are making a very good point, which is the following. Perhaps we are in the unprecedented time. But what we have for our laboratory, we have a variety of models where we can see what would happen counterfactually, what would happen during the time when the leverage is high. And I think it's very difficult, unless you really, jump backwards into all kinds of hoops, to get very large multipliers. Certainly there is some research which has large multipliers, but if I take your point at the face value, I would err on the side we probably don't know. So given that we don't know, should we really, stimulate this patient?
I guess most of us would argue we better be doing something now rather than nothing. Okay, we're going to open it up to questions from the floor, and as I mentioned, you could line up on either side. Yes.
So I have an observation and a question. In the initial graphs that Professor Woodford showed, I was struck by the fact that the upward slope of both the employment line and the output line were about the same in the last 3 or 4 years as they were in the period before. They had just dropped because of the recession. That's my observation, so I thought that was interesting. But I'm also wondering, is there a correlation between the decrease in manufacturing employment from 1970 to 2010, which I understand has dropped about 34%. So is there a correlation between that reduction in manufacturing employment and the slow recovery?
Anybody want to answer that? Does the fact that we have less manufacturing in the GDP today mean that recovery is slower? I think that's the other way to put the question.
There's the theory that manufacturing is more cyclical.
Right.
And we're more of a service economy, and so the economy should be more stable now.
Right.
The part of the economy that's suffered the most is the part of the economy that's down the most is housing construction and construction in general. That's where the most unemployment is. That's the category with the biggest drop in expenditure. And I don't know, that's a little bit like manufacturing. So I don't know that having more of the economy depended on that, I think we'd be in worse shape, not better shape.
Let me just add something about some misconceptions, I think, here. So if you look, it's actually a very good question. So in fact, if you look at the unemployment now, it also at the same time is correlated to the polarization of the US economy. So it looks like, I think there is some evidence supporting that a huge chunk of this lingering unemployment is coming from the middle of the distribution. It's not from the very high-skilled workers. It's not from the very low-skilled workers working for the non-offshoreable, non-outsourceable jobs. So it's this middle of the distribution which is being hurt the most, and probably the loss of the manufacturing in the U.S. has something to do with it.
Yeah. As a comment on the connection, I mean, I doubt that it's the reduction in the size of the manufacturing sector that's responsible. I mean, if one asks what the consequences of that has been for the stability of the U.S. economy, I would point out that if you look at the 20 years before the recent crisis, the volatility of GDP growth was notably low compared to previous decades when manufacturing was a bigger sector. And I think you could easily argue that the shift toward a smaller manufacturing sector might have been one of the reasons that the volatility of the economy had in fact become lower. Now, that obviously didn't prevent the kind of thing from happening that just happened, but if you ask me, what was it about the changes in the U.S. economy that made it possible to have the kind of deep and also difficult to recover from crisis that's just occurred, I would think there's another trend that's arguably connected with it, and that was the progressive deregulation of the financial sector that had also been going on in recent decades, and that I think has a fair amount to do with the creating the possibility of what's just happened to us. But I think, there's no connection I see, at least, between that and the decline of manufacturing.
Bill?
Just two comments. One is that if you look at the long-term development trends of mature high-income economies, well, what you first see is the decline of agriculture. So, for example, agriculture is down to about 1% of our economy now. And then you see the second trend after that is first the growth of manufacturing and then the decline of manufacturing, the share of employment. And that's a trend in all high-income economies. The other point I want to make is we have a very misleading image of what manufacturing is, maybe from the pictures of people striking the great iconic pictures, but the largest single job in manufacturing is chasing inventories. And so I think we need to really change our view about what manufacturing is. Manufacturing is design. Manufacturing is things like Apple. Apple, if you take your iPod, iPod is a beautiful, very highly profitable device, but it's actually very little of it is really made in the physical sense in the United States. It's made in probably with parts from 70 countries. It benefits from a great free trade zone, and we have the distinct advantage of living off the royalties from that. But that is manufacturing, but it's not our traditional image of manufacturing.
Yes.
Question for Professor Nordhaus. I hate to be the staunch Democrat and pick on the one thing where you said the Republicans had it right, but I'm wondering where you're seeing this. You said something about how the Republicans are more serious now about controlling healthcare costs, and that's something that we need to do. And from my perception of the debate, maybe that was, I think that maybe was true a couple decades ago, maybe during the Clinton administration, that that historically the Democrats were more concerned with expanding access, expanding coverage, and the Republicans were more concerned with constraining costs. But it seems to me that in the last few years, the debate about Obamacare has been basically it has basically been the Democrats who have been serious, yes, more about expanding coverage, but also about reining in costs. And the Republicans have been the ones who were crying death panels the moment there was any suggestion that we would use evidence-based standards of care and so forth. And right now, Mitt Romney, as far as I know, I mean, he's going around saying that that we should that he wants to repeal Obamacare, but keep the things that would basically expand access, like the not excluding people for pre-existing conditions and so forth, but get rid of all these things that would do something to curb costs. So I'm wondering where you're seeing right now, the Republican side being more concerned with cutting costs. It seems to me that what they're more concerned with in their rhetoric in the last few years has been basically preserving the pre-Obamacare status quo.
So just to repeat what I won't repeat what I said, but I'll put it in an alternative language. I actually was not, I mean, if you listen to the debates, there's actually been no informed debate about the Affordable Care Act. The president actually has barely defended it, and the attacks have been actually not about the Affordable Care Act itself. It's about the Medicare, it's about the effect on reimbursements from Medicare. So it's actually not about the Affordable Care Act at all. What I was saying was that the Affordable Care Act actually does not, and the legislation and the proposals do not deal with the long-term fiscal impacts of health care paid for by the federal government. Roughly, if you look at health care over the next 25 years, the share of GDP going to health financed by the federal government is projected to go up by 5% of GDP. So virtually all the increase in the primary deficit is due to increased spending on federal health programs. What I was saying is there's nothing in the Affordable, not that there's nothing credible in the Affordable Care Act, and there have been no serious proposals by the Democrats to deal with that. Now, the Republicans, by contrast, they have a very simple program. They just cut the programs out. They send Medicaid back to the states as a block grant, which basically will allow it to wither and die. And on Medicare, they have a plan which is basically would turn it into a defined benefit plan, which is a plan It has no public support. It will not get through Congress, and it doesn't deal with the problem of rising costs other than by putting it on individuals. So I just want to be clear what I'm saying. The problem is that you could say neither of them has realistic ways of dealing with the long-term fiscal impacts of the healthcare. I think that is it's a very difficult issue. We haven't talked about the substance there. It's a very difficult issue to solve, but I think neither of the groups have solved it in a way that both is politically feasible and intellectually accurate.
My question is for Michael Woodford. So earlier you had said that the Fed keeping its policy rate between 0.25, the lower bound, won't necessarily lead to hyperinflation because other interest rates were already low. I think you mentioned the money markets.
I'm saying the high reserves are not producing inflationary pressures given these other factors.
Right. So I was wondering if you could elaborate on that, because I have always thought of, maybe I confused your point, but I had always thought of the Fed funds rate as sort of the benchmark for other rates and as the Fed's way of guiding other interest rates. And so this is just sort of a new way of, I've never thought about the Fed funds rate in this way. So I was hoping you could sort of elaborate on that point a bit.
Well, the question, what I was talking about was the question of whether these unusually large level of bank reserves were going to be inflationary or not, and that depends on whether or not there's some problem with getting the banks to be willing to hold them. And what I had pointed out was that before the very unusual situation that we've been in the last few years, ordinarily there's a substantial opportunity cost to holding reserves, therefore banks are only willing to hold a very small level, determined by their need for clearing balances and things of that kind. And given this willingness to only hold a small level, even increasing them a little bit causes substantial changes in financial conditions because they have to occur to restore the balance between supply and demand. That's currently not operative in this situation where the interest being paid on the reserves, and that's not the federal funds rate, it's the interest that the Fed pays the banks for holding reserves, is currently at 25 basis points, not very high, but fairly high compared to other short-term interest rates. That's a very different situation than in the past. And I was pointing out that under those circumstances, very large reserve balances aren't inflationary. In the future, one could imagine that other interest rates are going to have to go up to not be inflationary, not because the federal funds rate doesn't determine them, but because the federal funds rate itself might have to go up to head off inflation under other conditions than the ones that we're in right now. But I was saying that even then, you could still have very large reserve balances. Consistent with that, it would simply mean paying interest on the reserve balances that are commensurate with the extent to which you're trying to raise other interest rates.
Yes.
Hi, I have a question for Professor John Geanakoplos. I think it's a brilliant idea to just write down the principles for those who are underwater. But I'm just curious about if you think, or how should we just pin down the extent to which we cut down the principle? And in addition to that, should we just cut down the principle for everybody, or should we just cut down the principle for those who are dippers in water? And the final question is, if we cut down the principles for those whose houses are in water, would it be a negative incentive for those who have been cautious about purchasing decisions so that they are not they are not underwater?
Yeah, thank you. It's good to clarify this. So forgiving sounds like it's bound to get you into trouble and be bad for the lender or create some bad incentive. But what I was suggesting, I don't think creates any bad incentives and is good for the lender. So imagine that you are a subprime lender. The guys who you lent to, his house is down to $100,000, even though he owes you $160,000. He has a terrible credit rating. He's almost surely not going to pay eventually. He's going to realize that he can't make the payments and he's going to stop paying. They were defaulting at 7% a month. So you could extrapolate forward by a year or two and realize they were almost all going to default. So if you know that by telling him, okay, we're going to throw you out of the house, you can't just throw him out the next day. It takes a long time to get him out of the house. In the end, I'm telling you a fact, not a conjecture, a fact. The subprime lenders got less than 25% back of the loans when they threw people out of their houses. 25%. In fact, it was closer to 20%. And already in 2008, the market understood that they were going to get less than 25% back. The market, you can see by traded securities, the market understood they'd get less than 25% back. So you could make more money for the lender by saying, well, so how much should you reduce it to? You should reduce it to just below what the house is worth. That takes a lot of effort. You have to go and sort of figure out how much could the guy sell the house for if he had to sell it now. So if he could sell it for about 100 and you reduce it to 90, now he's got a good incentive to try and pay the 90 because he can either sell the house and make 10 or it's actually he owns something. So it would help the lender and help the borrower. I wouldn't forgive the debt for people who already defaulted. The idea was to forgive the debt for people who were still current, but you knew were going to eventually give up and default. So you don't create any incentive for bad behavior because you're forgiving them before they've done anything bad. Before Greece does something horrible and just says, forget it, we're giving up, we're going to pay nothing. Before you get to that point, you have to tell them, we'll forgive something. If you don't, you're going to get to the point where they just give up and pay nothing. Then instead of getting, half of 350 million euros, that's 175 million, you might get nothing. So it can sometimes curiously help the lender to forgive part of the debt as well as the borrower, and of course that would have a tremendous effect on the economy. I don't think it would make people less likely to lend. As Bob Shiller always likes to point out at this point, he says he proposed a mortgage a long time ago which had the feature that if the Shiller index of housing went down, then some of the debt would be automatically forgiven. So that way, because it's better for the lender to do it, and you don't have a complicated negotiation about how to do it. So I think it would make the market thrive more, not less. We've come to a time where it's too late now. There have already been so many people thrown out of their houses, and the people left have not paid for 2 years. Now you create a problem if you reward them. Okay, and lastly, just because your neighbor gets his debt reduced and you don't, that doesn't mean you have to be angry. You'll be glad to know that your next door neighbor's house isn't going to be ruined and your house will be worth more, even though you don't get your debt forgiven because you didn't take out any debt. So. Yes.
Hi, I'm curious about Professor Nordhaus's 5-point plan. I was wondering why you favor letting the Bush tax cuts expire as opposed to more of like a Bull Simpson-esque, broadening the base revenue-raising reform, because the carbon tax doesn't exactly seem politically feasible, so I wasn't really sure if that was the issue, or if you just don't really like the research that Professor Tsivinski was talking about marginal tax rates, if you don't really see that as much of a factor in terms of economic growth.
I'm not quite sure I understood. So what I was talking about was the upper income. It's basically similar to what Obama has proposed for the last 2 rounds, which has let the higher income tax cuts expire, extend the lower income tax cuts. Just to be clear, that's a lot easier than base broadening. We've had one time in my lifetime when we've had any success in broadening the tax base in the '86 tax reform. It's just very, very difficult. If you want to just remember what's in there: mortgage interest, state and local taxes, employer-financed health. Raise your hand if you're willing to sacrifice those, please, for what are putatively lower rates. So, but it actually is feasible and on the bargaining table and possible to let the upper income tax cuts expire.
Just like a brief follow-up. So do you think carbon taxes are feasible, or?
If you'd asked me that, you would never have asked me that 20 years ago, because you probably would not have heard of it. You would probably wouldn't have asked it 10 years ago, because it wasn't on the agenda. It's actually on the agenda. To the extent when people begin to think seriously about climate change and what kinds of instruments are available, they could compare something simple like a carbon tax, which will raise a lot of revenue and have the kinds of fiscal impacts I talked about, or they could have a 900-page bill like the House-passed bill, which has slices of allocations of permits to every group you can think of and a few you couldn't think of. I think it's neater, it's cleaner, it raises revenue, it doesn't have the kinds of implications for bureaucracy. It's something that, it's actually interesting, if you look at conservative economists, sort of the Mankiws, the Feldsteins, the Boskins, the advisors to Republican presidents, they actually agree with the people who oppose it. They say if you're going to do something, that's the way to do it. So I actually think at some point, if you get the Wyoming senator out of the room, because the Wyoming senator's never going to agree to a tax that's on coal, if you get the Wyoming senator out of the room, it's something that actually would have broad consensus among economists. And at the point when global warming is taken seriously, it's clearly the best way to proceed. So is it going to happen this year? Maybe. Over the next 5 years, don't bet against it.
Very optimistic. Yes.
My question's for Professor Geanakoplos. You made the case that forgiveness of mortgages is good for lenders, and I'm inclined to believe you. You made a good case for it. But I guess if that's true, why didn't we see lenders forgive the mortgages? And I guess maybe forgive my lack of knowledge about the mortgage market, but if they didn't have that power, would it be possible if instead of the federal government forgiving all the mortgages, if they just gave the lenders the power to do so?
Okay, that's another very good question. So I was talking about subprime mortgages. That's where the crisis began, and that's where all the first defaulters were. And those are the people who are most likely to default because they don't have a credit rating to defend. So if they're way underwater, they have every incentive to walk away from the loan. They're almost never chased down and their bank accounts, taken or something like that. They just leave and So the reason why the loan wasn't forgiven, none of the debts were forgiven, is because subprime loans are pooled. They're not given just by banks. They're pooled together, about the subprime pooling, and then the payments that the homeowners make are divided up among bondholders. So in order to forgive the debt, you would have had to get all the bondholders to come together and agree and say, let's forgive the debt. Now, the person who had the power to forgive the debt was the so-called servicer. That was the guy who sends the bills out, collects the money, and divides it up among the servicers. But that guy doesn't own the bonds. Those are mostly big banks, and they had nothing to gain by forgiving principal. They wouldn't make any, in fact, if they cut the principal in half, they'd lose half their fee. In order to cut the principal down to the right number, the last guy asked me, you have to know what the house is now worth. You have to send someone on the ground to visit the house and to appraise it to figure out what it's worth. It's a big expense for them to do, and they're getting nothing out of it. So the op-ed I wrote in 2008 was, the servicers have no incentive to write down the principal. It's not to their benefit. And the bondholders who would like to get together to do it don't know who each other are. They can't find each other. So you need someone to intervene, like the government, and say, okay, the servicers are not acting as good agents of the bondholders. And so what we have to do is replace them as agents, not take away any of their income, just turn over the modification decision to government agents. And the government job would be make the modification that makes the most money as possible for the lender, for the pool as a whole. And so I think they would have written down principal a lot, but no one had the incentive to do it. So it was a consensus problem, a coordination problem. That's what government is for, to bring together people who don't know, who can't coordinate because they don't know who each other are. There was a consortium of 19 hedge funds that owned these bonds that asked Congress to write down principal. So many of the bondholders wanted to see this done. It's not such a crazy idea. Many of the, greedy hedge funds who had the most to gain by getting their money, they wanted to see the debt forgiven.
It's actually a lot simpler now because a lot of these very same bonds are now owned by either Fannie Mae or Freddie Mac or the Federal Reserve.
It'd be simpler now, but it's sort of too late now, unfortunately, because so many people are already, a few years not paying their mortgage. It's a lot more difficult to forgive their debt and not cause a moral hazard problem. Encourage people to, I was recommending it when you'd forgive people who hadn't done anything wrong. They kept their promises up till then. Now you have to forgive people who've given up 2 years ago. And it's a more complicated situation. It still might be a good idea, but it's more complicated now.
One over here.
My question is also for Professor Geanakoplos. So you talked about how Bernanke needs more power with being able to control leverage and stuff. I was just wondering if you could explain that a little more. Like, we have a kind of good idea of what causes interest rates to go up and down. I was wondering what sorts of things would cause him to change the leverage, or if it would just be a fixed ceiling, or if you could expand on that.
Okay. So I was at the Federal Reserve at Jackson Hole a couple years ago making this case, and someone asked me the very same question. How would you decide when it's time to limit leverage? And then Stan Fisher, who had been before a famous professor at MIT, who everyone here knows, who's now the head of the Bank of Israel, he jumped up and he said, housing prices in Israel took off. I was scared that there was a terrible bubble that was going to cause a calamity in Israel. So I simply forbade any bank in Israel from making a loan at more than 60 LTV. That's 60% LTV. That's a very stark and low number. Maybe I should have made it 70 instead of 60, but I knew something was wrong. The leverage was getting too high, and the housing prices were getting too high, and I thought people were going to be in danger, and so I put a stop to it. And so it's hard to get exactly the right number, but when you see the kind of housing surge that Bob Shiller pointed out, 90% in 6 years, and you see the down payments go from 14% on average to 2.7% on average, it's clear that they've gotten out of hand and somebody should have intervened. So the Federal Reserve didn't have the power to intervene, and secondly, they didn't know the numbers. So it turns out that the Federal Reserve was not at that time following down payments house by house. Now they know all those numbers, but back then they didn't even know the numbers. It wasn't regarded as an important variable to keep track of. Now, obviously, they keep track of it. I'll tell you one more story. So Trichet was at this meeting, the head of the ECB, and he said, it's great, we should definitely control leverage, but the Federal Reserve or the Central Bank of Europe shouldn't be in charge of it. It should be another agency that controls leverage, and the bank should stick to interest rates. And I said, that reminds me a little bit of the old Russia, where you had one bureau in charge of prices and the other bureau in charge of setting quantities. Wouldn't it be better if you had them together in one bureau? And Bernanke said, eventually the Fed is going to do it. We're just not ready for it yet.
So do you think there's a leverage that should never go above?
No, I think it depends on what's happening to asset prices. If the economy is very depressed now, I think that the Fed should intervene to try and increase leverage however it can. And if things are booming, that's the time when it should try to curtail leverage.
So you don't think that they're like 97% you think is acceptable at some point in time?
The Fed is, the government is now making 97% LTV loans to a certain class of veterans and things like that. So I think it's actually too high. I would almost always think 97% was too high, but definitely it shouldn't be one fixed number that never changes. But thank you for the question.
There are actually many tools to control leverage, not just mortgage rates. You could regulate the margins on which stock can be purchased. You can regulate the reserve ratios that banks have to hold in the Federal Reserve. You can regulate capital ratios, which we're in the process of doing, and indeed the Basel III regulations that will go into effect in some years into the future actually have a built-in countercyclical provision. The capital requirements of banks there's a discretion to raise those in a boom and lower them in a recession. So we're making some progress on this point in other areas. I think it's been 2 hours, which is 33% more time than any of the presidential debates. I hope that those of you who persisted think that there was at least 33% more content in this discussion, and I think some of the panelists will be happy to stick around and pick up the questions of those of you who still have them for a few minutes informally. But I think we ought to liberate the audience, and thank you very much for being good listeners. Thanks.
Got you guys. We can't let you speak last.